As to the passive is eating the world, I think at the margin, I think that's probably what happens in any bull market. People go with what's been working, and the S&P 500 is the best performed asset class or asset in the world over that sort of period of time. You can get it for 9 basis points. It's got a Sharpe and a Sortino ratio that look like a hedge fund. It's an incredible run for that, and it can soak up a lot of assets. But I think that this is true at every bull market, that people invest in what has been working, and the moment that that breaks down, the money will go somewhere else.
All right, welcome to another Resolve Riffs. Today we have an old friend with us, Toby Carlisle from the Acquirer Funds and from the Acquirers podcast and blog. And I know you call it Value After Hours, your YouTube show. I like to think of it as Value After Dark because your voice is just so calming and so value after dark. Like I think you might, I would contemplate submit to you for a name change to Value After Dark with Toby Carlisle. Would
Yeah,
be
we
It's
might
the
do that.
Mhm.
has to be the
So
accent.
yeah, so congratulations on a fantastic year and last 3 years for your ETF ZIG, outperforming S&P on both of those time frames. Fantastic work. Still flying under the radar, though, as many assets and geographical regions, whether it's gold, whether it's Argentina, whether it's value, so many places are actually doing well and outperforming the S&P, providing great diversification. Yet most people aren't, really allocating in any significant way there. So I know we're kind of early on beating this drum, and well, we beat it through all the way through the tough times too. But hopefully people can take away some insights here from you. And maybe before we get started, for those of you who may not know you, Toby, maybe give us a little bit of your history, how you came to this point. I mean, going from a lawyer down in Aussie to a value funds manager in California, maybe map it out for us and bring everybody else up to speed who might not know you.
Yeah, I started out. That's a very kind introduction, Mike. Thanks very much for that. Always good chatting to you with the big lead in, the big build up. Yeah, I was a lawyer. I was a mergers and acquisitions attorney. I was corporate advisory, is what we call it. So I did everything from capital raising to acquisitions to board papers to like just whatever was needed for mostly publicly listed companies and big private companies. Um, I started in April 2000, which was the very top of the dot-com 1.0 boom, and saw that all collapse, and then saw the rise of activism and private equity through those early 2000s. And at the same time as I was sort of papering these private equity acquisitions, which is a lot of work. There's lots of different layers of capital, debt, equity, prefs, whatever might be in there, plus the acquisition. And just there's so much contracting, you'd end up with a tower of paper at the end of it. And it would cost millions of dollars of legal fees. At the same time, you can buy exactly the same business for cheaper on the stock market. And at the time, it was $8 a trade. I don't know what it is now, but it was $8 for me to trade, buy the same business for half the price. And then if you make a mistake 2 days later, you can tip it out for another $8 round trip. And I had read enough sort of Buffett and Graham by that point to know that these things happen. You find, pieces of businesses that aren't trading for the full negotiated price on the stock market, even though they might be worth more. And I just kind of fell in love with it. It was fun. And it was a good period for value. It was easy to buy things that were undervalued and they just run almost immediately. And so I spent the first sort of 5 years or so of my investing career doing pretty well with deeply undervalued stuff. And that all sort of collapsed in 2009. But I decided I wanted to go and try and do it professionally at that point. So I set up a little fund in Australia. Had some pretty good returns out of the gate, but just was never going to be a structure that could raise money in the States. My wife is American. We met when I was working in San Francisco as a lawyer. And so we moved back to have kids. And I started the business here. And it's been a tougher run for value, as everybody well knows. Those starting and depending on how you measure it, starting in 2010 or 2015, somewhere in that period of time, value really started underperforming. And I've got a friend, Mikhail Samanov. He's done this analysis. He called it 200 years of value, and he said this was that period through to 2020 was the worst underperformance of value in 200 years of value. Clearly, as you go back in time, the data's not as good. But what is pretty clear from it is that you get these often associated with some sort of technological boom. So the invention of the telegraph was a big one. Steamships was another big one, and so on over the last sort of 200 years, where every time there's been an electronics boom in the 60s, the dot-com 1.0 boom, whatever it was, the sort of dot-com 2.0 social kind of boom that we had through to 2020. And I guess now we've got a little micro boom going on with the AI. But whenever we have these things, it tends to be the story stocks that don't have a lot of fundamental value run, and it draws money away, and it sort of leads the rest of the market to underperform. So that's what I've invested through. And I know we're going to talk about this in a little bit, but I've definitely had to adapt from a more traditional value to sort of a different sort of style of value to that practice now.
Well, even I think that was interesting I know you make the pilgrimage to Omaha each year, and the Berkshire annual meeting, and so we're looking forward to get some tidbits from that. But even in that, I heard a lot of that, the evolution of Warren's thinking, because they paid so much time to Charlie, and Charlie's thinking was a little bit less value oriented than Warren's thinking, and maybe you're alluding to that sort of thing in your own journey as you have been managing value assets in what has been it's been, obviously there's lots of stuff around this value, but if no one else is realizing that and kind of beating a path to that door, it leaves you with lots of value for a period of time that is less comfortable than having the realization right away.
Well, I actually think that's an interesting point, because I think that if you're relying on, that was one of the big changes that I made, was that through really it was through 2020 and 2021, when, well, 2020 out of that sort of COVID low through until the end of 2020, that was a very strange time. Everybody was at home with nothing to do, speculating on the stock market. And so I saw like lots of extra hits on my websites and on my podcast and on my social media. It grew really quickly. Even though I'm a value guy and I was well out of all of those names, I'm still involved in the stock market. And so I was getting attention for that reason. And the stuff that I wouldn't touch with a 10-foot pole was the stuff that was running, and the stuff that I was holding was suffering as a result. And it wasn't clear. Everybody knows these things are cyclical, but it's hard to believe that it's cyclical in the moment. I thought, what if this does go along forever? And I was listening to some of the other smarter value guys who are a little bit more growthy than me, listening to what they were saying. One of the criticisms that they have had of the very deep value, so I would characterize myself as deep value, which is I tend to buy less good businesses at a big discount. That's sort of my objective, rather than a really great business at a fair price, which would be the way that Buffett characterizes what he does. So I thought one of the criticisms that was valid of what I did was that, aren't you just really relying on price action to be the thing that bails you out? Because we all know that if you form a value portfolio, the market expects the earnings to fall or not perform as well as the market earnings. And that tends to be what happens. It's just that they have overestimated how bad the returns are going to be. And then the stock price recovers as a result. So it's this funny kind of behavior where the earnings are actually going down, but the stock price is going up because of the little window when you own the stock. And the reverse is true for the growthy stuff. The market expects the earnings to go up, and they do on average go up. It's just that they disappoint the market and the multiple comes down. But somebody said, aren't you just relying on price action here? And that's not very value-like, is it? That's not very fundamental, because that's not what fundamental value guys do. And I thought that was a fair point. So I went back and I retooled what I did. And I looked at it and I made this assumption: what if we had to invest with no price performance? What would we be doing then? We're purely relying on fundamental performance. What would I construct then? And so I leaned a little bit more into quality. I made sure that when we bought something, we'd get some compounding out of the reinvestment. So you need a reasonable return on reinvestment, reasonable prospects for compounding reinvestment returns over a period of time. And then also for some yield. So some shareholder yield, which is dividends, buybacks, hopefully buybacks for undervalued things, but not every management team does that. And I feel like I now think in two distinct terms of value sources when I buy something. We're going to get a return out of the yield. We're going to get a return out of the compounding. I don't rely at all on the price action. I assume that price action is going to catch up to us over time. And I think that's a pretty safe assumption. I don't expect it to at all. And I'd be quite happy for my entry multiple and my exit multiple to be the same. And I'd purely rely on the fundamental performance of the business over that period. So I think that that's a pretty big change that I have built in. And I think that it's sort of yielded results. And I expect it to over time. So when Zig first launched, it was a long short fund. It was 130% long, 30% short, 30 names long, 30 names short. So a long name was 4%, short name was 1%, rebalanced regularly without fear or favor, because the shorts can be a problem. Shorts have got leverage in them. They can run the wrong way. You can get hurt. I invested through that period where Melvin Capital blew up. I thought we did pretty well through that period, but we were all, I had, my great fear was always that we were going to get caught in something that ran. So I'd make sure there was no momentum in the stock. And I think that that's sort of, for the really growthy names, that's their rocket fuel, or their mojo is all of that momentum. The moment the momentum gets out of those stocks, the people aren't interested in playing with them anymore. It's like the toy just gets discarded. So you can look at the charts. As soon as the momentum goes in Beyond or Peloton or any of those kind of names, they just disappear. For a variety of like not very interesting kind of technical custody reasons, we couldn't get as long as I wanted to be. And so we were sitting at 100 long, 30 short through the beginning of 2020. So that helped us on the way down. It protected us a little bit, hurt us on the way back up in that mania. So 2020 wasn't a great year for Zig. And then in 2021, converted to long only because I thought that there's some existential metaphysical risk with the shorts. Like even if they never actually blow up, there's always a risk that they do. Kind of hope that the fund gets big enough one day that it's a big fund, and then it's harder to short at that kind of size. So I thought, I'm going to take this medicine at some point. Doesn't really align philosophically with the way I am. So I'm going to change to long only, which happened in 2021. So since 2021, 2021 was a good year because that was sort of the end of the stock market run up. 22 was I thought was the beginning of a big bust, but ultimately didn't turn out that way. And then 23, we had a really good year. I would not have expected it at all. I thought that all of the macroeconomic indicators were terrible. And really the lesson that I've learned is that I know nothing about macro, and I'm just going to shut up about macro and ignore macro forevermore. I think the market can fall over 50% at any given point in time, and you should be able to survive it. But aside from that, macro is just a waste of time. So I'm a long only value investor, bottom up. I'm about as plain vanilla as they come these days.
I love it. You hit on just one last thing, Richard, and I'll let you jump in. But you hit on a point that I have always kind of giggled at as I've heard various value investors like Warren or others, say market timing is not a thing you can do. And at the same time, they use value sort of fundamentally driven mechanisms in order to decide whether to have cash on the sidelines or not, whether to have more cash on the sidelines than one normally would or not, or to invest more or not, which is a form of timing. It's just timing by a slightly different nature. So I'm glad you highlight that. That's kind of it's always kind of a funny thing that I giggle about.
They might say valuing rather than timing. They're valuing
Right.
the market.
Fair enough, which is an exposure mechanism that
I don't do that. But
yeah,
I'm just
totally get it. Totally get it. And you've answered the question too for the Zig funds. Now, Richard, you've been waiting patiently. You've got some things to say, so let me shut up now and let you.
I have some things to ask. No, I'm just sort of curious. We hear about a lot about this narrative that, passive is eating the world, and that might be one of the main reasons why there's been this incredible bifurcation that's been lasting, I guess, a couple of decades now, with this underperformance of value versus growth. So I'm wondering, do you subscribe to any of that? Do you see other reasons for this underperformance? Obviously, you've morphed and you've been alluding to some of the ways in which you've adapted your style over the years to sort of account for these changes. But I'm wondering, does it even matter to your style? But have you gone down the rabbit hole and trying to understand what are some of the mechanisms, structural mechanisms that have led to this underperformance and this bifurcation? And does it begin with this passive eats the world sort of thesis?
I am not a subscriber to the passive eats the world thesis, and I will talk about that. But the first, just let me say that the reason that I think that value has underperformed, you can look at the relative value of value and growth as another alternative. So let's just say that quality or growth, better businesses should command a premium price. Worse businesses should command a discounted price. If everything was fair, that would be what would happen. What tends to happen is there's a little bit of mean reversion in business performance as well that I think a lot of people miss. Things just don't go to zero. When oil was trading at a negative number, that's not a signal to sell oil. If anything, that's a signal to buy oil at that price.
Don't
And
extrapolate at the extremes.
that's right. And that's the original paper, the Lakonishik, Schliefer, and Vishny paper from 1994, which is the sort of alternative to the efficient market theory Fama French paper, which is that all value is risk. The the behavioralist guys say no, it's not all risk. There's a behavioral thing going on. There's extrapolation. They extrapolate at the top, they extrapolate at the bottom, and mean reversion is a better bet. So I bet on mean reversion, not extrapolation. And I think that if you looked in 2015 at value, the difference between the best businesses and the worst businesses that was so squashed together because value had such a great run through the 2000s. Everybody was trying to buy the undervalued stuff. And for a little bit of a premium, you got a much better business. And I think that that's why from 2015 until sort of today or the last few years, the better businesses, the growthier stuff, the NASDAQ stuff has all had a great run because they were too cheap and value is too expensive. And I think now the spread is very, very wide and the spread has been closing. But the spread is still very unusually wide. It's still as wide as it was in 2000, wide as it was in 2009 at the bottom, both of which went on to have very good value runs. I think that is really what has driven the underperformance of value. It got too expensive in 2015. It's been working off that being too expensive. And now the trend keeps on going all the way to the point that value is undervalued and growth is overvalued. So I think that we probably see some mean reversion over the next decade here. That would be my bet. As to the passive is eating the world, I think at the margin, I think that's probably what happens in any bull market. People go with what's been working, and the S&P 500 is the best performed asset class or asset in the world over that sort of period of time. You can get it for 9 basis points. It's got a Sharpe and a Sortino ratio that look like a hedge fund. You know, it's an incredible run for that, and it can soak up a lot of assets. But I think that this is true at every bull market, that people invest in what has been working, and the moment that breaks down, the money will go somewhere else. In any case, I don't care because I'm not investing, as that discussion I had earlier about not relying on the price performance. If I was an investor in the value stuff and they bought back shares and they were all cheap, they would, you know, axiomatically they must perform better. Like the cheaper they get with a buyback mechanism, and I'll be the last person left owning those stocks. Like if there's no bid and I own all of those stocks, I'm an incredibly wealthy man. But there's no longer any bid on the market, and so passive's eating the world. But I've made a whole lot of money. It just doesn't logically. It can't work. I'm picking the pocket of those big funds if they're not doing the fundamental diligence that I'm doing. I'm picking the pocket of SPY. Like anything they're leaving behind is something that's worth owning. So I don't believe in. I think flow's affected in the short term, but ultimately in the long run, fundamentals are the thing that drive the market.
Money goes where
Well,
it's treated best.
yeah, voting
And by
machine versus reading machine, I guess, is the is ultimately where you
yeah,
follow
That's what
on.
it
And
is.
so, yeah, and so,
just
but
look at oil, right, Richard. Just as a point, 2008 oil, the energy sector
yeah,
of the S&P is 16%. It then bottoms at 2% in 2020, and it's now 5%. So underneath the surface, and this is what I was alluding to earlier, there are changes going along. If you look in the resource space, if you look in the emerging market space, look in the value space, gold breaking out to all-time highs, the materials world sort of again, highs not seen for 15 years. And everyone is still myopically focused on the market cap weighted stocks of the United States, which are, obviously victims or, they also take advantage of the extreme momentum that comes from a market cap weighting system. So I think under the surface, there's still enough active managers where money is, flowing under the surface on a longer term time frame to where it's being treated best on a return, whether it's cash flow or some sort of more fundamentally driven, higher probable event that treats the money better, if you will.
I think the trend turned in Q3 or Q4 of 2020. I think it's already happened. I think people who are
Mhm.
waiting for it to happen are completely missing the boat. The train is leaving the station right now.
Mm.
It's already left. I mean, I think that's why I think it's a little bit funny having these conversations because I've been living in a world where Valley's been outperforming for the last 3 years.
Yeah,
You know,
but it's okay. I just to put a point on that. I don't think we should suggest the train has left.
oh no,
Usually
no, no,
these very
leaving.
large secular movements are very
Yes.
large ships turning. And so, if we look at those moments in your career that you outlined earlier, Toby, and talking about 2000 easy times, 2010 a little harder times, you know, it seems as though easier times are upon us. And, it's probably going to be, if you zoom out and look at quarterly and annual data, you're going to see it and you're going to see the outperformance. But over a day, a week, a month, it's going to be shrouded in noise.
Or even since the start of this year,
Mhm.
you would say this year has been more of a that AI that kicked off Nvidia and AI has certainly reinvigorated all of that the growthy stuff, and they've had a phenomenal year, many of those guys. And value has sucked wind a little bit this year, to be fair.
But that's what I mean. On a longer basis, step back, look at a few quarters, look at annual, and it's just there. Try to talk to people about it. My goodness, forget about it. Japan, Argentina, these, significant outperformance of US equities, and people are like, don't care. And this is sort of indicative of that 2000 period too, right? This is not new,
No, well, that's to be
as you
expected.
said, from history.
People tend to look through the rear vision mirror when they're investing. They look at things that have already happened, extrapolate that forward. Fundamental investors are just looking at the underlying fundamental data and trying to figure out what's going to happen. Are we getting a good deal buying now without really knowing, expecting what can happen? That's sort of the way I think about it. I'm whatever happens in the market, I don't really mind. I'm going to be happy owning the things that.
So let's pull on that thread a little bit. You're alluding to the fundamentals. So you run a few stock screening processes. I know that you have a service that you offer that. So I would imagine that does permeate through your process, your investment process for your actively managed stuff to some degree. What else goes into that process? Is this the stock screening an initial filtering, and then do you overlay with some discretionary? Are there other elements to that you can tell us about?
So we look at the domestic US equity market only. We get North America, so we pull some Canadian data as well, but it's well, the funds are only invested. Canadian data's excellent, and I think that value really works well in Canada.
It
It's
really
amazing.
does.
I don't know why it works so well there, and it works better in Canada than it does in the States.
Maybe
So
all the resource stocks that get their
maybe,
value upside down, yeah.
or they're just not as picked over. But the um, the US market is where I invest in for the funds, so I don't buy. I only buy US listed companies for the funds, and so I can scan all of the companies for the amount of money that they're making, you know, the amount of money making that they're relative to what they've got invested in the business. Um, and so I am purely focused on the financial statements. When I say I'm a quant, I mean I'm a lawyer. I don't have a PhD from Booth or from Wharton or like I'm not a Chicago quant in that sense. I'm just a quant in the sense that I prefer the financial statements to the story that people tell themselves about these businesses. So I think that all of the questions that you have about a business or about management can be answered in the financial statements. And so we look at a series of financial statements for every company and we try to figure out what's happening, how much money are they making, what are their prospects for growing, what are their prospects for paying out pretty good shareholder returns, try and find the best risk adjusted opportunities from the set that have no blow up risk. So we're trying to take all the blow up risk up, and that's quite a few tests, but that's like, looking at statistical tests of fraud and earnings manipulation and financial distress, and using all those sort of standard tests, and then looking at various other things just to see how management treats the financial statements. So once we've narrowed it down to an investable universe for both of the funds, so ZIG is 30, Deep is 100 names. Then among those names, we go and do a forensic diligence, which is just, does the financial statement match the economic reality of the business? Because there's a lot of discretion for managers to make decisions. Two perfectly reasonable people can create two different financial statements for the same business. Over time, they should largely balance out, but you look at accruals of different assets and the way that they depreciate and so on. If you're an owner-operator style manager, you're probably running it to minimize tax, and that means minimizing reported earnings. If you're a public company CEO whose compensation is based on stock options and all of that sort of stuff, you're trying to maximize earnings. And they're two different styles of running a business. My preference is that I want to be with the owner-operator type guy. And so the system is set up to try and find investors and managers like that. And then I'm doing a diligence where I'm actively looking at how far away is what I would think that the earnings should be from what the actual reported earnings are. And is there a trend in there? Do they tend to be consistently and growing over-reporting of earnings, or is it the other way around? Are they consistently under-reporting earnings? Some of that is answered in the cash flow statement. And then we form a portfolio based on what I think are the best risk-adjusted opportunities with no blow-up risk. And that portfolio is then rebalanced on a quarterly basis.
How do you account for the, sectors and subsectors and sort of the value, being all in one sector or largely in a couple of sectors? How do you go through that?
Yeah,
And
that's
position sizing, if you can add that, how do you think about position sizing? Does it conviction weighting? How do you think about those
yeah.
aspects?
So that's a great question. So the thing about value is that sectors and industries all get cheap. Everything in the industry gets cheap at once. And if you're just purely trying to maximize returns, you want to be fully invested as much as you possibly can in that industry. There is the problem, though, that every now and again you get things like for-profit colleges, where for-profit colleges all got cheap, but ultimately that was an act of the administration to kind of wipe them out. And so if you invest in the for-profit colleges, there was no recovery from those investments. So I'm always conscious of that possibility being out there, and I never know if I'm looking at something is the reason, and that could be insurers. When Obamacare was coming in, you had United as the biggest, and the other four were trying to combine together. How big a bet do you want to take in that? What will be the impact of Obamacare? I don't know at that point in time, but I want some exposure to the industry because I thought they were cheap, and I also thought there were opportunities in the merger arbs going on there. But so I try to limit the exposure to any industry to 20% of the book. So we have a limit, which is 6 names out of a 30-name portfolio, 20 names in a 100-name portfolio. So we're always limiting, and then we are equal weighting at each rebalance point. So I've done a lot of research in different ways of weighting using Kelly or all of the different things that you can do. And I wrote a book called Concentrated Investing, which is largely about that, trying to figure out how concentrated or otherwise you want to get. I kind of found that for the ease of calculation, 30 names is sufficient diversification. I think that the efficient market guys come out at 30. They're trying to create a portfolio that matches the market portfolio as cheaply as they possibly can. Graham says 30 names. All of these, I think when you do the work, somewhere between 20 and 30 names, you get rid of all of your non-diversifiable risk. And it's just asymptotically trending towards the market. the question is, how can you outperform? How can you deviate from the market? So you're not randomly picking names, you're picking them according to some system, value, or whatever. So 30 value names out of a universe of 1,000 for ZIG, and it's a universe of 2,000 for deep because it's roughly Russell 2000, roughly Russell 1000 universes. 30 names for the Russell 1000, 100 names for the Russell 2000 is 3% of names, or sorry, 0.3% of names, or 0.5% of names. So I think that you're already very concentrated, equal weight in that group for ease of calculation, and I've found that works perfectly well.
And that's the difference. So ZIG is more mid cap, large cap, and deep is more maybe mid cap, small cap, or
So
is that the
that
main difference? Or
that's also quite an interesting question, but it's Russell 1000 roughly for ZIG. So it's the largest 1000, which is mid and large. But at
yeah,
the moment, Morningstar has it as a small. The centroid is over the small. And the reason is through like I haven't directed the portfolio to do this. It's just that as the market has got more expensive, it seemed to get more. I really think the last few years, rather than being sort of a value market, it's really been a large over small market rather than a sort of growth over value, or however you want to characterize expensive and value. It's been a large, not small market. Smalls have been absolutely smoked. And so the portfolio was a $40 million median about 3 years ago, and it's something like 8 in ZIG at the moment. So the market caps have come in dramatically in ZIG, and also in deep, which is Russell 2000. The centroid sits right off the bottom of the Morningstar square. Like you can look at that box. It's in small and micro that's where I think the opportunities are all small and value, but particularly the size, for whatever reason, that spiking interest rates has sort of led all of these smaller businesses, because they haven't termed out their debt as well as the mid and large cap companies. So their debt is all, they've already started paying the higher rates, where the mid and large cap companies haven't had to roll some of their debt yet. They haven't had the bullets come through, whereas small and micro have. So they're paying like 10% rates to borrow if they can get the debt. And so I think that's why they've really stumbled. And you can see it in their earnings reports. You can see that large cap earnings have largely recovered. S&P 500 earnings have recovered and have gone above their 2022 peak, whereas mid and large are still trading below their 2022 peak. And their multiples are much compressed as a result. The S&P 400, S&P 600, which is mid and small, trading at about 15, 14 times depressed earnings, whereas the large caps are at like 20, 21, 22 times pretty extended earnings. So to me, that says that if you believe in mean reversion, the opportunities in the small and mid, and if you look back, small and mid have traditionally traded at a small earnings multiple premium to large, and now they're at a big discount. So I think that'll flip over the next few years, and that's where the opportunity is small and value particularly.
yeah. When you hear about the demise of the premium for small caps in the research, that takes a good solid, decade or more of underperformance to get that headline that, hey, the large cap or small cap value premium is dead, or that market cap premium for investing in smaller companies is dead. I kind of always, when I hear those, the data is changing. We have 100 years of data and it's now changing. I'm like, is it? Or are we
Well,
just at one of those extremes where it's going to revert and go back to where it was?
I agree with you that there's highly likely to be mean reversion in there, but I think that even if you just look at if you look at the expected returns for the prices that you're paying, the returns are higher in small and mid than they are in large. I think they're considerably higher.
Mhm.
So I think that my deep fund, because it's cheaper, has a higher expected return at this point than ZIG, which is can only choose from a slightly bigger universe, even though it's exactly the same process in both funds. They're just selecting from different universes. So I do really think that the opportunity is in small and value, and then the smaller is better than the bigger.
Sorry to interrupt, but I did want to take a quick second to remind listeners that while we do absolutely love providing our audience with world-class guests and weekly investment insights, we wanted to remind you that we actually do our best work outside of this podcast. And we try to do this by providing cutting-edge, globally diversified, and systematic investment strategies that are designed to be broadly non-correlated to traditional equity and bond portfolios. So we actually manage private and public funds, as well as bespoke separately managed accounts for investors that seek the potential to smooth out portfolio returns in the long run. So if you do want to see that theory that we've been talking about put into practice, please do go ahead and check us out at investorsolve.com. Now back to the podcast.
Now, how do you trade some of that smaller micro and small cap those positions? It's probably not an issue now as the funds are sort of smaller and in their infancy and growing. But is there a point at which you're going to reach capacity in that domain?
Certainly it's going to reach capacity. I don't know where that level is. That's going to be an ongoing thing, but that's why it's 100 names. So they're all fairly small positions. There's also, if you're running an ETF, you have liquidity risk management program, and you also have an NYSE market capitalization cutoff of about 75 million. So it has to be a market cap bigger than 75, and it has to be sufficiently liquid to trade. And so it has to qualify on two different measures. So all of the names that are in the fund qualify on those measures. And, you're probably leaving some return behind by not being able to pick up the really small, really illiquid stuff. But, there's some risk being in that stuff if you're in a publicly traded vehicle.
Oh
Like
yeah,
an
and
ETF.
and there's costs, right? That you've
Yeah.
got slippage in those. That
Real
is
slippage,
not.
yeah.
Yeah, it's significant, right? The bid ask spreads are large, and acquiring and disposing of have some significant slippage that often will eat significantly into what can be actually realized. So you have to, it's a slower approach. It's a slightly different game to think through. And some
The moves in
constraints are
those
different.
the moves in those little fellas are crazy. I just every now and again I check in just to see what those 100 names have done, and there'll be a few names that are up 15 or 20 on the day, and a few names that are down 15 or 20 on the day. And that's probably just, that's not. There's no news. There's no event. It's
Yeah.
just somebody trying to trade them.
Yeah. Bob wanted a
You,
boat and he's selling
That's it.
some shares.
That's it.
you
Oh, boy.
alluded to a moment ago about sectors often becoming cheap altogether because of some macro catalyst or something along those lines. But you also said that you're done, or you try to eschew from making any macro predictions because that's not your game. How do you account for trying to diversify within the portfolio and not have overly concentrated positions on any single sector? Do you impose any constraints from a sector perspective? How do you think about that problem?
Yeah, there's a sector constraint. There's a industry sector constraint, which is, and it depends on how we're defining industries and sectors, but where it's no more than 20% of the book in any industry. So that gives me enough exposure, I think, but it also protects us in the instance that it's all for profit colleges, for example, which there's no recovery from. And then we're updating on a quarterly basis too. So we're continuing to examine, are the financial statements still supporting us being in this position, or was the market right? Because that's the way I think about it. We're not, there's some arrogance in saying the market is totally wrong about this, because of course the earnings and the underlying business can deteriorate, in which case we've made a mistake. We've paid too high a price for a business that's deteriorating. And that's what the market is often doing. It's forward looking. They know that these events are coming and they're not yet reflected in the financial statements. So the way that I think about it is we're either paying a price that reflects those worse expectations, in which case we're probably, if it does manifest that they're getting worse and now the opportunity doesn't look as great, we just take the position off and move on to something else. Or the market has overestimated, it's over extrapolated, and there's a pretty big recovery when the next print comes in and it's not as bad as everybody was expecting, and then you're off to the races. And that's sort of what we're trying to achieve. But I'm always very aware that there's a lot of avenues for making mistakes and for blowing up in this business. And that's really the thing that I'm most focused on. I just want to survive, because there's always another cycle coming. There's always a better cycle coming.
The
My
war of
objective is
attrition.
yeah, you got to be there. You got to be there for the good cycles. I mean, that at some point we're going to have a value cycle like we had in the early 2000s. And it would just be a crying shame to have missed out on it because the growth cycle beforehand was so brutal and you didn't make it through.
Yeah.
But I think we're getting close to a big value cycle. So I'm pretty excited.
Yeah. Is
You
there any, I know you mentioned that, you know, you're not really paying attention to the global macro side of things, but are there any potential sort of risks or opportunities that you see the sort of the pricing mechanisms where you're like, okay, this group is really cheap, or, you know, my screens are focused over here, and you can sort of see the macro overlay that would lead to that?
I think that value, when things get very cheap, that's a good time to be looking in that sector because it says that the big macro event has happened and everybody's aware of it right now. Oil
Priced
goes
in.
oil goes negative. All of the oil majors get smashed to smithereens. You know, housing was another interesting one. Before housing kind of took off, the thesis, well, lumber got very expensive. You know, when lumber had that crazy run through
Yep.
COVID, all of the housing builders got smashed to pieces. And I thought the housing builders were way, way too cheap, but they were also in a market where there was a lot of underbuilding because of the GFC more than a decade ago. We just haven't built as many homes in the States. And so there's going to be demand for homes. Housing builders are cheap. Lumber being too expensive, that's clearly a short-term problem that's going to resolve itself over time. And the home builders went on a pretty good run. I didn't foresee that sticking up interest rates as rapidly as they did would make the premium between new homes and um, existing homes so much smaller, or in fact, it would flip over where it would be cheaper to buy a new home than it would be to buy an existing home because
Yeah.
the home builders could give you the rate buy downs and all that sort of stuff. And so those home builders have had this sort of generational little period of trading. But that's one of the nice things about value. I didn't see any of that happening. I just thought, well, home builders are too cheap. But then, of course, it's all of the macro that drives all of the craziness that goes on. And I just don't think it's not that I'm ignoring it. I watch it and I'm naturally bearish. So I can see that there's a yield curve inversion out there and, there's a war going on in Russia and there's some conflict in Gaza. There's always conflict and there's lots of good reasons to be nervous about stocks. It's just that I can go back over the last decade because I have been bearish over the last decade and I can go through all of the things that I was bearish about that none of which manifested into, anything that happened in the stock market. So I just think macro is so hard. It's not that it's wrong and it's not that it's worth paying attention to. It's just that it's so impossible to predict the third or fourth derivative knock-on effect and how that will impact the stock market, that the energy devoted to it is just a little bit of a waste of time. So I'm a beneficiary, I think, sometimes that something gets cheap for a macro reason and I'll buy it for the macro reason. And I'm probably a beneficiary on the other side, bailing me out of the position and making it work. But I'm largely just ignoring it and saying, well, it's cheap now. And now it's less cheap. And I'm a buyer and now it's less cheap. I'm a seller. That's how I think about it.
It really does seem, I mean, historically, at least in the last couple of years, it has been really a patience game to be a value investor, which comes with its own behavioral challenges. I mean, you end up having these lumpy returns at times, right? You wait for a long time until the waiting mechanism of the stock market finally leans in the direction, and you have whatever catalysts are going to drive the price up, and you're going to realize that value in the business that you or the businesses that you have been selecting in your portfolio, which kind of jives a little bit with the experience that CTAs and trend followers have had, which is kind of our side of the ledger here, where oftentimes you do get these lumpy return profiles. How do you think through that behavioral challenge for yourself as a manager, but also for some of your stakeholders and your investors when you're talking to some of your to your allocators and you're pitching them this fund? Do you account for that behavioral difficulty and sort of the fortitude that one must have in order to stick to? Because I find that value is one of the more intuitive things one can get behind on from an investing standpoint. You buy something that is below its intrinsic value, and then you wait for that value to realize. But a quarter goes by, a couple of years go by, and it's still not happening. And with our attention spans growing shorter and shorter with all the social media and all these apps, how do you think through all that?
I I think that again, that's the single most important question to answer as an investor. And I I think the more time that you spend in the market, the more you realize, and I talk about this with Jake Taylor, who's my co-host on Value After Hours. It's amazing how many of these little stock market bubbles, these little things occur, and everything gets so hot and everybody's so interested in this one thing for about 3 months. And then it's just, completely back page of the paper thereafter. And if you can just not participate in it for the first 3 months, then it looks silly. Like in the fourth month, you look back and you think, how did people get into this? And then I look at names like, so Dillard's, Ted Weschler's one of Warren Buffett's investing lieutenants. He's underperformed the stock market since he started investing for Buffett, but he's had a couple of very good picks, and one of them was Dillard's, DDS, which is still out there, and it's one of the companies that I hold now as well. Dillard's is a retailer. All retailers got smashed to pieces over the last 5 or 10 years. Dillard's was one of them. Dillard's got way too cheap. It was in all of my screens, and I'd buy it and sell it, and buy it again and sell it again, because just as it sort of bounced around a little bit, but it didn't really go anywhere for 5 or 6 years. And then through COVID, whatever it was, the stimulus, whatever it was, it took off and it 10-bagged in about a year. And now it's up about 18 times from where he put on his initial stake. I think he doesn't have it anymore, but that 6% stake that he bought is worth like $360 million. And it's an 18-bagger since he put that position on. And all of it happened in a very short period of time. So the compound annual growth rate for the holding period, or the IRR for the holding period, is like 36% plus over the 7 years. But it's really like only a handful of years that have delivered the return. So I see those things and I think that's a good reminder. Just because the market doesn't recognize this initially, what we're focused on is the fundamentals. And at the beginning of this, I sort of started talking about that a little bit, but that's sort of what it means. Like, ignore the price action, stay completely focused on the underlying fundamental performance. And if the fundamental performance is trending in the right direction, then everything's good. Just stay cool. And so I've definitely found myself, I've stepped back from social media a fair bit. There's not a lot of utility in it for me because it's just way too short-term focused. So I put the positions on. We rebalance in a quarter, which means I'm going to get another quarter's financial statements. We'll update all of our models. We'll form up, our ideal portfolio. And then at the end of the quarter, we'll look at the differences between the ideal portfolio and what we're currently holding in Zig. And we trade to make the Zig's portfolio look like the ideal portfolio. And that's the process. So it's not a lot of opportunity for me to overtrade or anything like that. I sort of just stick to the process and I don't worry about it too much because now I trust it too. I've been doing it for long enough that I know that if we buy cheap and good, it will work out over time, even though, you can have a look at the returns. In 2021, it was a pretty big year. It was like a 37% year. But then in 2022, it was like a down 17%. And 23 is like an up 30% year. And then this year's like up 6 or something like that. And we're underperforming a little bit, but that's what happens. It's clumpy. Even though the portfolio is going forward all the time, it's only reflected in the stock price sort of in fits and starts. And that's okay. That's the way it goes.
The idiosyncratic lightning strikes a few spots of the portfolio, creates some returns, rebalancing happens.
That's it.
And then, you're waiting for those lightnings in a bottle again. So when you're doing it though, are you sort of at the end of each month looking back at the quarter, whoever reported in that particular quarter and updating there, or is it just literally, 4 times a year type?
No, it's the portfolio. There's a model portfolio that's updated all the time. It's pulling in all of the new reporting. And at the end of the quarter, the model portfolio will have deviated from what Zig holds because it's just turnover in the positions. It's force ranking all the positions all the time. And so we'll trade to make the Zig's portfolio or Deep's portfolio look like the model portfolio.
Oh, so it is a quarterly rebalancing.
Yeah.
So you are only rebalancing 4 times a year.
Yeah. And I tested that. I've tested, the more you rebalance, you're getting a lot more friction, you're getting a lot more costs, and you find that there are things that they just move in and out all the time. So you're buying and selling this one thing over and over again. That still happens on a quarterly basis, just less regularly. But you also got that, Corey Hofstein had that great paper where he identified all of that timing luck, all of that rebalancing luck. And I had been aware of that as anybody who does a lot of back testing, you become aware that if you start the portfolio in 1 January and you rebalance yearly in 1 January, you get much better returns than if you started in September and you rebalance it in September without sort of knowing why. And if you started in March and you get a rebalance, it's really close to that 2009 low. The returns are like twice as good as if you rebalance in September. So there's clearly, I want to be able to eliminate as much of that timing rebalance luck as I can without incurring all of those additional sort of frictional trading costs. And I think quarterly, you probably don't need to trade quarterly, probably yearly is enough, but it just captures that timing rebalance luck sufficiently that I think quarterly is okay. Quarterly is the number.
And stepping away a little bit from the systematic process and just kind of putting your discretionary hat on a little bit, what are some of the things that are gotten you excited on a micro level or a sector level? What are some of the things that if you were inclined to sin a little, like as a value investor, looking at all these companies and looking at the opportunities from a cyclical standpoint, you just described yourself as excited or growingly becoming more excited with the opportunities, with the forthcoming opportunities for value as a whole. What are some of the things that are getting you excited?
Well, one of the things that I do is I track the book. So I know what the book is, I know what the expected return is across the book because I have a calculation for each name where I know what the fundamental expected return is. So when the fundamental expected return is going up, I feel better. When it's going down, I feel worse. But when it's going down, it's outperforming. And when it's going up, it's underperforming. So I have managed to kind of train myself to feel better when the returns are worse because the forward returns are better. And so I think the forward returns are better now. We've got to concentrate, we just tend to be buying we're deep value. So it means we're always going to be in steel, we're going to be in coal, we're going to be in oil and gas and energy. We buy little busted industrials that I think can do a little bit better. I have a little bit of trouble distinguishing between them, honestly, because they all have idiosyncratic problems. And the reason that they're in the portfolio is because they have idiosyncratic problems and they work their way out. If I was going to sin and be discretionary, I'd be much more in things like, probably I'd look at something like Starbucks or something that's, had a pretty big stumble, but ultimately, that's a good business. I like businesses like Shopify. I think Shopify is an incredible business. I mean, I'd be out there buying all of those kind of names, knowing that the way to own these things is to buy a little bit now and you just don't even worry. That's like a 10-year position, 10-year plus position, and you just let them run and let the underlying business kind of figure itself out. But I would like, really good businesses after they stumble. I'm not so much of a speculator that I'd go in and, I wouldn't be trying to time oil or time coal or anything like that.
So a little bit more opportune quality type stuff, a little bit more in the direction of
Probably Buffett, yeah, more in the direction of Buffett. Because I do think that that's one of the things that I've tested, I just turn off my sell rules. And so just buy and just see what happens over a full period of time. And it's interesting the way that these things, you start with 30 names and you can look forward 25 years of these 30 names and you end up with this portfolio at the end. And it's heavily concentrated in the things that have worked. But if you start with 30 names, heavily concentrated might be a 5 to 8% position, which I would think if a position has worked its way up to that, it may have earned that right to be that sort of size in the portfolio. And it'll all be stuff that's worked. So your positions it'll be Apple, Microsoft, Starbucks. You have this portfolio that looks like a Kelly betting value investors portfolio, even though it's just completely, the system has selected these names and it's just allowing time to work means that the ones that compound are the better businesses and the ones that don't work just disappear. They're rounding errors or they're trivial. The interesting thing is how much capital they throw off. So buying on a free cash flow basis, holding for 5 years, the yield across the portfolio could be 10 or 15% at inception. You hold that for 5 years, half of that comes back, half of it gets reinvested in the businesses. You find that you've got like a third of your portfolio capital back after 5 years and you've got to reinvest it anyway. So I think that you end up being it's a Buffett, you're kind of imposing this Buffett style cadence and investment style on yourself just by virtue of the fact that you have this never sell and own cheap quality stuff. You
beat your winners to death, which is what you'd be doing here. You'd be saying, well, I'm not going to sell my losers either, but they are, asymptotically going to approach zero or hit zero, leaving the successful pieces of the portfolio, which were just well-timed purchases of
just luck.
what happened to be successful companies because you bought them with those characteristics.
That's right.
Yeah, yeah. Keep your winners, people. Beat the hell out of those. Sell your
When you're
losers.
when
That's
you're
not what
thinking,
Zig does, though. That's not what Zig does. I'm
No,
just
I understand. Yeah.
just
sorry,
thinking
Richard.
through, no, thinking through on a sort of longer term hold, and your two strategies in the deep value space, do they comprise 100% of what you're investing for yourself personally? And the reason for why I ask is, how do you think about dealing with like a 1970s sort of scenario, or scenarios that are difficult for stocks as a whole, even though you might have a large margin of safety for some of the businesses that you're holding, and so they might, in relative terms, be outperforming the S&P, or some of your other benchmarks in a downturn. But do you think about some complementarity on a style basis, other diversifiers, anything along those lines?
I have a lot of cash because I need a lot of float in my business. And so I need, because I'm a small business guy, no other source of income. I have float in the business and I have float personally as well. So that's a lot. I have a lot of cash relative to the assets that I have. But I have all of my investable assets in Zig and Deep because I just think that a manager should do that. And I think that that won't always be the case. I think if we got massive outperformance for an extended period of time, then it would be okay to take some of that off and mess around with some other things just to try to be a little bit more established and careful for my family. But at this point, I feel like I should be eating the dog food. Not that I need any more focus on it than I already have, but I just feel like I should be participating along with everybody else. I I think that the prospects for these companies are always pretty good. I look back through, we can run this data back through 1963. It's not forever. There's lots of other things that have happened outside of that, but even through the 70s, these things did okay because this is the kind of strategy that does do well for a more inflationary period like that. That's not to say you can't have some sickening drawdowns through that period of time, but I do have some cash that I would opportunistically deploy. I just tell my wife that we're going to be investing in the market's down a lot. We're going to be buying some right now, so we can't do anything else for a little while. She's all right with that. She understands.
Love it. The value investing wife is a critical component of investment success.
She really
for sure.
is. She really is. She knows what she got into, though. She understood. I've been doing this before I knew her.
I love it. I'm wondering now if we could maybe switch gears over to Omaha. But Richard, before we do that, do you have any final thoughts? Because you were pulling some threads there, so I want to make sure you've got
No,
all
let's
your
go
answers.
forward. Let's go to
All
Nebraska.
right. Yeah. So you usually go down and attend the pilgrimage to the Berkshire annual meeting, and I understand you did this year as well. How was it, Toby? And what's the good, the bad, and the ugly?
Well, this was Charlie Munger passed away at the start of the year, so it was the first year without Charlie. So that was kind of poignant. Buffett did turn and say, he often gets Charlie to chime in on something he said, and he turned and he said Charlie at one point. So he said, I've gone to do that 2 or 3 times, but it's kind of slipped out. And then he had Greg Abel, who's the chief executive officer, who's also taken over the equity portfolios. And so it wasn't the 2 other guys who had been sort of tagged. At the moment, it looks like the CEO of who he's mid-American, but now he's CEO of the whole thing. And he's also looking after the equity portfolio. He seems to me like he's very smooth, very controlled, like very high EQ kind of guy. And he concluded one of the things that he had said with nothing further to add, which was the very famous Charlie Munger line. He always used to say that, which the crowd loved. So I thought, I think they're doing the transition. I think there's probably a transition going on now from Buffett to Abel. Buffett's, phenomenally articulate and thoughtful 93-year-old man. But at 93, you can hear how fast he used to talk when he was in his 60s and younger than that. He sounds like you're listening to a podcast on 1.5 times speed. And now he doesn't speak as fast as that, and he takes some diversions to make the point. So I thought from that perspective, there's a transition going on. That was what I took away. But the other, just outside of that, I think that there are principles of investing that that I learned from them that I think I've only grown to appreciate why they're so important over time. And one of them is, and I've written a book. I've given this. It's with a publisher now to decide whether we do it or not. But it's basically looking at some of the underappreciated aspects of what they do. And I think that one of them is this idea of, they look at character as one of the elements of people who they do business with. And it's hard to understand why as a or I just didn't really understand why it was so important. I mean, it's just, if you're looking for opportunities wherever you can get them when you're young and hustling. And it's only after you've been burned a few times, I think, that you realize how important character is in business partners and other things like that. So that's an interesting one. And the other one is just that you cannot blow up. You just have to be able to survive every single market environment that you see, because Berkshire has famously underperformed for long stretches of time, and they haven't done very well in others. There's always a magazine cover that will let the world know at that time Buffett's lost it. And then it's often, it's close to their bottom. They're just about to go on a really great run just after that. And I think that's true of most strategies. A lot of the ways that my fund works is we're in an industry that's beaten up, and some of the people in the industry leave because it's just, they've either got too much
Too
leverage
hard.
and they can't make it, or business is just too tough. There's easier money elsewhere, and they move away. And then they get these supernormal returns in the industry. And that's what I'm trying to capture, the supernormal returns. It's true also in investing in a value portfolio. You get these, you blow up, you miss the bit that comes afterwards. So I think that has been their sort of underappreciated strength. They just muddle through in the bad times, do really well in the good times. And I think for me, those are the things that I really take away. Those two sort of principles: do business with good people, and survive the bad times so you come out on the other side.
I'm interested as a lawyer that you didn't pick up on that earlier. I mean, given that the other parts of the firm may have been involved in the negotiations between those who lack character in certain business dealings,
You might think that you can paper over it. Like I
right.
wouldn't have thought. Some people regard the contract as like the ticket to the fight. That's where we're getting started. Some people are trying to find their way through it as you're drafting, and other people are like, well, that's the spirit of the agreement. We're going to follow through with it, regardless of what the contract says. So those assessments, I don't know how you make those assessments other than just dealing with people a lot over an extended period of time and seeing how they operate. Getting older, I think, probably helps.
Yeah, it is a pretty consistent theme, even though they reiterated it this year. I think that's been a fairly consistent theme through the years, not only from
Oh, sure.
them, but from others who are, sort of the various lieutenants, like Porish. There's a I think it's his name, Porish, the Indian guy who, emulates a lot of the stuff. He's been on record as saying that being one of the more important factors of, you should fit it on one page, because you can't contractually obligate people away from bad behavior. If you have a bad actor, you have a bad actor.
I mean, it's certainly true in small cap world, right? There's a lot of small
Mm.
cap managers who are, owner operator is great unless the owner's sort of making all of his returns through salary and option grants and things like that. Ideally, you want, so Tesla's a good example. Like Musk's pay package is huge. That's like $50 billion kind of option grant, which has been turned down. You see that all the time in the small and micro world, where they get these big slugs of options and they move all of the timing of it around. And that behavior, technically it's legal, but do I want to be in business with with someone who's doing that? Probably not. I want someone who wants to make money with the shareholders as well. And that's where it's really important, which I think all of that is observable in the financial statements and the proxies and things like that. I don't think you need to do any like psychological analysis of the management or anything like that. I just think you look at the financials and it tells you. You don't have to listen to what they say.
Love it. So anything else from was it noticeably different, given that it was televised for the first time? Did you see any other,
It's been televised before. It was very full. It was a very full year. Um, Last year was less full. I like doing it because it's the one place where all the value guys who I know all gather together in one place, so we all catch up and have dinner and drink and a few things like that. That's sort of the interesting one. My wife doesn't care if I go to this thing, 'cause it's all very, very nerdy dudes.
She went once and she's like, never
Oh,
again.
she'd never get, no chance.
Everyone commiserating about, I bought my Berkshire back in 1982. When did you buy
That's
yours?
a big part of it. That's a big part of it.
I love it. What a wonderful tribe created on that, sort of buy and die type of framework of ownership.
Yeah,
It's
it's a
pretty
good
interesting.
crew. It's a good group of people.
So you got you've intimated you got a book maybe coming. So I don't know
Yeah,
if
it's with
if it doesn't go with the publisher, maybe you should self-publish, man. It
well, I have
sounds like a pretty
self-published.
neat book. Oh,
I self-published the last one. I've got no problem self-publishing. I just think this one needs a little bit of help. So I'm trying to find a publisher who can actually edit it a little bit. So it's with Harriman. Probably it's going to be with Harriman, unless that falls over, in which case I'll self-publish.
nice.
And what's the theme of the new book? What are you focused on?
So it's Sun Tzu and Warren Buffett, the overlap between the two philosophies. Sounds crazy, but I do think there's a lot of overlap, and Graham
I
as
love it.
well. There's a lot of overlap. I think Sun Tzu's a little bit underappreciated. Sun Tzu talks about following the moral law, which is like an idea of like looking for character and trying to do the right thing. And that's how you know you're going to succeed, because you're doing the right thing. And ultimately the bad guys fail. That's Sun Tzu.
Love
And
it.
winning the battle before it's even fought. Maybe there's
Yeah. Knowing how
an
you're
anal-
going to, yeah,
yeah.
that's such a big part of it, right? Like how many people buy stocks because they've seen it going up, and then when it stops going up, they don't know what they're doing. Like that's the idea. You figured out how this thing's going to play out before you buy it, and you figure out how you can lose as well. And so when you start seeing the signs of losing, then you get out.
Yeah,
Well, yeah, that's
it's
actually
go ahead.
an interesting sort of portfolio construction question. Do you operate with any level of stop losses?
No,
Okay.
no, I would buy them all the way down, and that happened with Meta as well. I started buying Meta at what I thought was half value, and we were still buying at a third value. And I thought that the business itself, the business, again, it's one of those hard things where the stock price was following the free cash flow generation, which was collapsing because Musk was reinvesting in the metaverse. And we're all sealed into that with Musk as he flies it into the sun or whatever he was planning to do. But at some point, he changed his mind and decided that he's going to go turn it into cash flow generation and pay a dividend. And it worked out okay. So I think
You're
that
talking about
that's
Meta?
yeah, Meta.
Zuckerberg.
What did I say? Musk. Yeah, Zuckerberg.
Yeah.
Sorry, Zuck.
Yeah.
Yeah.
Okay.
I love it. So outside of finance, any other hobbies that you're into that would maybe surprise people? Little insight into this Australian former lawyer, deep value investor in the heart of California.
I play a lot of tennis. My wife's a former D1 tennis player, so uh, that's always humbling. Go and play some with her, and then my kids play tennis as well. So we spend a lot of time at the tennis courts, playing a lot of tennis. So that's I think tennis is a great sport, particularly for kids, because it's to master the stroke is a difficult thing. Mechanically, to hit a ball is a hard thing, but then it's hard to score. The scoring is crazy: 15, 30, 40,
Yeah.
juice, add, nuts. Doesn't make any sense at all. So
Different
the kids,
tiebreakers.
which side of the court you stand on, who's serving, all of that stuff is complicated. And then after you've mastered the mechanical stuff and you've figured out where you've got to stand, then you have to work out how to beat somebody in a point. And that's the really hard stuff. And most people don't get to that point. So
Have you
I want my
figured out?
kids to master it.
Have you figured out how to beat her? Because as a former D1 player, it sounds like she'd probably beat you most games. Is that
Well, you can't rally with a D1 player. You're just going to get pieced up. So the only way to beat a D1 player as a man is to serve and hit a hard serve. So I'm going to win the point, on the first stroke, or on the third stroke when she recovers, or I'm not going to win it. And
I love it. I
I've
serve, I
come to,
return once, and then I stop.
that's it. That's it.
I save
sort
my
of-
energy. Otherwise, I save my energy.
That's the only way, because once you get they love to rally. Like that's what they're brought up on. They rally all the time. They hit these crazy
consistency?
hard
Yeah.
balls.
But you got to do the Pete Sampras thing.
Serve and volley.
Yeah.
Yeah, I'm a Aussie, so I'm Pat Rafter serve and volley
Fair
style.
enough.
Yeah.
All right. So, I mean, that's awesome. Little tennis. I know you were at Indian Wells. My wife was there too.
Yeah.
I'm surprised you guys didn't bump into each other. You didn't know each other. But,
It's a fun. I recommend Indian Wells. It's a real party
Yeah.
atmosphere. There are some girls at the club. One of the girls at the club is a pro. Well, there's a few pros at the club, but one of the pros is playing in the double too, and watch the doubles.
Oh,
It was
that's awesome. When you've got
Yeah.
someone there that's that that's even better.
And doubles is exciting.
Oh yeah.
So I don't know. It's like I'm less worried for them. It's just the crowd's going bananas. It's more like any other sort of sporting match. Whereas the singles is like they suck all the oxygen out of the room. Everybody's very stressed and tense when the singles is going on.
No one's allowed to say anything. You
It's,
can't even sneeze. Don't stand up and change seats or something like that. You're going to get,
there's a lot of
booed out of the
cheering in the
stadium.
doubles. It was cool.
Yeah, it is fun. That's awesome. Now, what about on the personal side? Any personal mantra or last bit of investment advice that you could share with everybody that's guided you through the ups and downs of the investing world? Because we're about an hour, so we're starting to wrap. And what are the you've just penned a book with Buffett and Sun Tzu in mind. So I mean, there's got to be some fantastic Eastern wisdom coming out that you could share with everybody that's going to change their lives.
I I really enjoy. I read Graham, Intelligent Investor, years and years ago, and I read Sun Tzu many, many times over the years because I think it's very hard to understand the way that he writes. It's a translation from ancient Chinese, and there are lots of different translations, and the translators disagree in the best way to express some of these ideas, and they're vastly different between the translations, the meaning. What I found is that there's the original one, which was written in 1910, is probably the one that most people have read. And I think that's probably the best one. But there's also one that came out in 1989, which is looking at the Taoist influence of the art of war. And I think that, and I had never really had any exposure to that. So I went and read the Tao Te Ching and the I Ching and the Zhuangzi and a few of those other things. And I was kind of blown away by there's some interesting wisdom in those things. And a lot of it is about patience and letting things sort of unfold the way that they should unfold. And I think that that's very apt for investing. And one of them that that stands out for me, that Richard sort of alluded to it earlier, but you should have a good enough understanding of your subject matter and what's going to happen in this sort of engagement when you're putting these positions on, that you should be able to read the signs of it going badly or it going well, which is distinct from what the stock price is doing. Because the stock price is a little bit misleading, I think. That's how other people feel about it. What's actually happening in the business is revealed internally. And that's what the Taoists and Sun Tzu would say as well. You've got to look internally, ignore the surface. So I think that the Tao begins something like caught in desire, you see only the you see only the surface, but if you can see the mystery, then you sort of, if you can see inside, you can see the mystery. And that's what that's what I want. I want to see the mystery. I want to see what's going on.
All the answers lie
beneath the
within.
surface. That's it.
Very poetic way to end. I want to see the mystery. I
Absolutely.
like that. That's great phrasing.
I think it's reality. You want to see reality. You want to see the mystery.
Yep.
The
Love it.
generator.
Well, everyone, that's another hour on Unresolved Riffs. Toby Carlisle acquires funds. Zig, Deep, those are the tickers. They are smashing it. This hour flew by. Tobias, always a pleasure catching up with you and sitting and chatting. And thanks so much for
Thank
taking
you.
the time.
Yeah,
Yeah,
thanks
thank
for
you.
having me, gents. Thanks, Richard. Thanks, Mike. It's always great catching up with you guys. Good seeing you.
Likewise.
Sorry to interrupt, but I did want to take a quick second to remind our listeners that the team works really hard on these podcasts. We spent a lot of hours trying to get the right guests, and we do a lot of prep work to make sure that we're asking the right questions. So if you do have a second, just do hit that subscribe button, hit that like button, and share with friends if you find what we're doing useful.